The higher the tariff, the more likely it is that the company will come into the United States and build a factory in the United States so it doesn't have to pay the tariff.
If he asked you to leave, would you go?
No.
Welcome back, everyone, to Ask Avidian. This is Jake Borbidge, Chief Investment Officer at Avidian Wealth, and I'm joined again today with Robert Palmer, our Head of Financial Planning. Robert, it's been a very interesting last couple weeks. We have a new president-elect. We also have a full Republican sweep now. I think we've confirmed that in the Senate as well as in the Congress. So a lot of things are probably going to change starting January of next year. We've been watching the markets react. The markets have had some pretty meaningful reactions in the first couple days, even the day before the election, which was kind of interesting. I think the markets did a good job of anticipating the win. They may have even anticipated this kind of red wave that we ended up seeing. Much better than we saw in the polls, much better than the data we saw even coming out of prediction markets. I think the markets overall, you saw that Trump trade starting to trickle through the Monday before the election, a little bit more in Tuesday, and then substantially more Wednesday, Thursday, and through the end of the last week.
And I think that S&P gain was the largest S&P gain right after an election in history, I think.
Yeah. So the markets definitely like the election results, at least in the short term. And, markets typically are a forward discounting mechanism for things that will probably happen over the next 6 to 12 months, or at least things that are likely to happen over the next 6 to 12 months. So what we're seeing today is definitely the markets pricing in a lot of change, some good, some bad, but definitely a lot of change. And I think the first thing that we're going to talk about today is tariffs. Tariffs are a word that Trump has used many, many times. We haven't tried to do a Google count on it, but I'm sure it's in the hundreds, if not the thousands, over the last couple of months. It's a word that he has a great affinity for, and it's also a tool that he has used in the past, so we know there's a bit of a track record established there. So let's talk a little bit about tariffs. Robert, what are you hearing so far in terms of how these are going to be used and when they may be used?
Yeah, so our country has used tariffs quite a bit. It predates income taxes, for example. That's how old tariffs go back to. Ultimately, what it is basically a tax placed on goods that are imported to America, and there's a lot of controversy around them. Some people believe it's really good for bringing jobs back home or bringing businesses back home, repatriating funds. Other people say it's just going to pass an added cost to the consumer or to the business owner, and it's going to drive prices up and have an inflationary impact.
Okay, so we're starting the basics here. A tariff, like you're saying, is just a tax on a product that comes from somewhere else outside the U.S.
That's
right. Tariffs can be something that is product specific. They can be something that's country specific. Is that correct?
That's right.
Okay. Who pays tariffs?
Well, ultimately, what happens is the U.S. government taxes it, and then whatever revenue is generated from the purchase of that, portion of it goes back to the government.
Right. So at the end of the day, the higher price is seen by the purchaser, which is the U.S. consumer, right? And the government receives a piece of that purchase as revenue.
That's right.
Now we've seen some other things about, okay, we can use tariff revenue to offset other government revenue requirements, right? So let's talk about how the Trump administration is referencing tariffs in terms of how are they planning on using tariffs going forward?
Yeah, and I think some historical examples are relevant here to kind of depict how tariffs can be used. For example, during the first Trump presidency back in 2016, there was a China tariff that was placed, and Apple was very concerned about this. And so you had Tim Cook calling up Trump, and he basically was like, hey, look, you're going to price us out of the market. We need to figure out a solution. And Trump said, well, okay, I'll give you a waiver. And waiver is something that the U.S. government can give to certain companies or certain products and basically avoid the tariff. But he did it in exchange for something. And the deal is that Apple would then build the next factory here in America and bring jobs here to America. So that's an example of how you can see tariffs being used as a bargaining chip with companies in order to promote job growth domestically. Another good historical example would be Toyota, right? Back in the day, we were very concerned with the amount of imports that we were getting from Japan, and so a Japanese tariff was placed. And as a consequence of that, Toyota moved manufacturing back into the United States to effectively avoid the tariff because now it's a domestic product instead of a foreign product.
Yeah.
So very cool how you can bring businesses here and jobs here, but there's a pro and a con and a balancing act that you have to consider, which is that added cost and that inflationary impact that could potentially happen.
Okay, so just kind of broad brush tariffs, right? You're pulling money out of the system, you're putting it into the government hands. That money's coming from the consumer. So broad brush, they tend to get painted with a negative light, right? That's right. That what you're pointing to are very tactical examples where tariffs have resulted either in an intended benefit to the U.S. consumer or the U.S. economy. Sometimes it's intended, sometimes maybe it's ancillary. I think another point that's interesting with Apple is we've seen over the last, maybe it's more of a COVID thing, but we've seen a diversification of their supply chain to move outside of China. So I think the iPhone 16, a large percentage of those are now made or at least assembled in India. I don't know if the actual components are made in India, but a lot of those are being manufactured and assembled in other parts of the world outside of China. Part of that's probably tariffs or the threat of new tariffs coming online. Yes. And then part of it's probably just having diverse supply chain needs for your manufacturing chain if there was anything shut down, any future shutdowns like we saw in COVID. So in terms of like the tactical mindset, right? When we look at how the administration has talked about using tariffs, we've seen a number of countries on the list of potential tariffs. But if we look at what went into place in 2016, all of those tariffs, I think, are still in play, right? So Trump put a number of tariffs in place in 2016. We don't have a list of them. I don't want to go through those line by line. But the Biden administration, I don't think they pulled any of those back. I think all of those, for the most part, stayed in place. And so
they had to.
Yeah, they had to.
We think about it as a geopolitical bargaining chip, but there's also a bargaining chip for business owners that can be thrown out there as well. Under the Trump administration, when the tariffs were imposed, at the same time, there was a repatriation tax that was also offered to businesses as a one-time payment to bring their business back to the United States. So, in addition to just all the things we've been talking about up to this point, there could also be an escape hatch and a low tax implication for bringing your business back to the U.S. if you're doing business abroad, which could also promote jobs and GDP.
So that's a feature that I think had in the past, last time it was used, likely benefited the large multinational global corporations, right? Typically, when we hear about tariffs, we think about, when we think about what Trump is doing, we think about him trying to organize benefits to smaller kind of, U.S. homegrown companies. So we see these things as kind of broad brush negotiating tools. We see there's some intended long-term beneficiaries, right? The long-term objective of these tariffs is to reinvigorate American manufacturing, right? That's typically what you hear in the rhetoric. But during the course of trying to get to that end objective, there's going to be winners and there's going to be losers, right? And there might even be some collateral damage along the way, and there might be some companies that benefit tremendously. So, think about, let's talk about how tariffs have the potential to impact earnings, right? Because as equity owners, again, we have to always come back to what do we own as an equity owner? What matters to us when we buy stocks, when we buy private companies? It's the earnings of those companies, to some extent the price we pay for them, but also probably more relevant is the earnings going forward for those companies. So companies that are going to, we'll call it not have much of an impact regarding tariffs. There's other things on the horizon that could have a substantial impact. So financials, right? Financials, banks, lending, that sort of thing. Not a lot of trade happening there that tariffs are going to meaningfully impact, although the currency side, there could be something to talk about there. Manufacturing companies that bring in a lot of raw materials. The U.S. doesn't manufacture or doesn't produce a lot of raw materials, right? A lot of raw materials now, or especially now, are coming in from China, coming in from Canada, coming in from Africa, right? A lot of different countries out there that supply raw materials. So manufacturing companies, traditional industrial companies, those are likely going to be in, I wouldn't necessarily say the crosshairs, but they definitely are at risk of either significantly higher supply prices for a short period of time, or potential supply chain disruptions if there's a tariff that causes a need to reorganize your supply chain. So those are companies that we're definitely watching, right? Companies that we think will or should benefit in the short term with regards to tariffs would be companies that are tend to be smaller in nature, tend to have a more of a localized source of supply chains of products. Could be companies that have very strong controls over the end price, right? So they're manufacturing something where there's not a lot of competitors for it, and if they do feel inflationary pressure on their supply chain, they just pass it along to the consumer, right? And so, generally speaking, I think there's definitely some winners and some losers that we're going to be looking to take advantage of here.
So to kind of sum up, if I'm a small business owner that's importing raw materials, I got to kind of pay close attention to the news and when tariffs may be imposed, because if I'm importing those materials, my cost of goods is going to go up.
Yeah. So think about, I mean, even a coffee shop, right? So small coffee shops might be something I would consider under the, collateral damage side of things, right? All coffee manufacturers, they import, all beans come from outside the U.S.
Oh, a tariff on coffee would just be the end of the
Can
world.
you imagine that?
No,
But I would expect a large multinational coffee, distributor like a Starbucks, maybe they have the skills to navigate and kind of rework their supply chains, whereas a smaller chain or even kind of your mom and pop privately owned stores may have a challenge because they may only have a handful of relationships, and if your relationship is impacted by tariffs, then that puts you at a disadvantage, right? So that's kind of an area where you might see some collateral damage. If we just take a pivot and look at what the market's done since the election, since we had the results and leading up to the results, we've seen definitely a shift in leadership. Which I think, you wouldn't tie all of that shift to tariffs. It's hard to disentangle the impact of tariffs, of deregulation, of a change in cabinet positions with Mr. Musk being one of those changes in cabinet positions, and we're seeing some stocks respond as a result of that, or changes in what could be happening, influences on the Fed, right? So all of those 3 or maybe even 4 factors are being digested at the market, kind of in real time, but simultaneously as well. And what we saw over the last few days, a little bit of that has reversed, call it now that we're about a week in. We've seen small cap stocks rally hard. That's the most notable impact other than Tesla and DJT, which I think are, kind of ancillary issues. We've seen small cap stocks rally significantly. We've seen the market leadership change, shift away from, kind of your mega caps, your Mag 7s, over to more value-oriented companies, more broad-based leadership, which generally is a tailwind for portfolios like ours that are more diversified in nature, that tend to not follow to a substantial degree and don't follow the market cap weighted indexes on a one-for-one basis. But it's been interesting to watch that shift. Now, this is a small shift, right? This is a sentiment reaction that we're seeing. We're basically seeing the activity of rhetoric being priced into reality through the markets. But I would say there's still a non-zero probability that those rhetoric statements do not necessarily make it into policy, right? Or they may change along the way.
Yeah.
So it's been interesting to watch that. But I think that's probably a good place to pivot to our next topic, which is the potential influence the president may try to have over the Fed and over Jay Powell specifically. So
the greatest market maker in history.
The greatest market maker. Wait, which one? Trump or Powell?
Jerome Powell.
Okay.
the chief of the Federal Reserve.
Yeah. So interesting dynamic going on there. Robert, you have a law background, right? So let's start there. Does the president have the legal authority to just kick him out?
No. Just that's the simple
just a
answer.
Flat out no.
Flat out no. Indirectly, potentially. So the Federal Reserve, I believe, was started back in 1913. Don't quote me on that, but I'm pretty sure it was 1913.
Yeah. Can you tell us the day and the month?
December 23rd. How's that?
Nice. Okay. Good job.
That being said, the way that the act was created, the Federal Reserve Act, and that was in response to bank failings and monetary issues, and the Federal Reserve was originally created basically to stabilize the money supply. That was really what it was, and to ensure that private bankers weren't necessary in order to rescue banks, and that the Federal Reserve would be there to rescue the banks instead. Mm-hmm. The way the act was written is that the governors for the Federal Reserve are voted on by Congress. So it's really Congress that controls the Fed. And they can issue votes for who they want to be put on the board or who they want to replace somebody on the board. The president himself has no authority over it. So even though there is a federal tie with the Federal Reserve, Fed is in the name, it's not a direct appointment by the president like some other positions and cabinet members may be.
Okay, so I think it's fair to assume that if the president doesn't want you in that position, he can probably take the joy out of life by speaking out against you, making your life generally just less enjoyable, but doesn't have the authority to actually remove you from that position.
Not directly. He can work with Congress and consolidate political power and votes and get someone voted in, and then the governors can vote on who they want to lead. But it's not something that the president can directly do, and it would require a huge consolidation at the House and Senate level in order to kind of win that over.
So in terms of, president's power, can't remove him. Congress could, if they had a desire to do so. They're going to have a lot of other stuff to work on. This might not be the top of mind issue for Congress to get to. Congress also kind of gives him his job description, right? Mm-hmm. And right now it's a dual mandate. If Congress had a desire to do so, could they change the job description of the Fed?
No. At least not by my estimation.
Okay.
It's because it's defined by the Federal Reserve Act, and that's really what the mission statement for the Federal Reserve is, that dual mandate of kind of maximizing employment and stabilizing pricing.
Okay. So one thing I think is probably worth noting is now, again, we're a weekish past the election. We have had one rate cut since the election. Does not seem to be influenced by the president. I think that was largely baked in going into the election, 99.5% probability that we were going to get a cut. In November, we got a cut in November. Everybody thought it was going to be 25 basis points. 25 basis points is what it was. So very limited influence seen so far. I think what we've seen coming out of rate markets, though, leading up and also since the election, is a higher floor on interest rates, which is kind of interesting. So I think the market had been pricing in some pretty substantial cuts, maybe even 50 basis points of additional cut in December. The odds of that cut have come down. Now the market's pricing in 25 basis points, baked in at a very high probability, but almost a zero probability that we're going to get a 50 bip cut in December. And so likely this is going to be the last small cut that we'll see. But the market has also kind of set a higher floor now for subsequent cuts in 2025 and 2026. I think the new floor is probably right around 4%. So I think we're like 4 3/4 now. That kind of means just maybe 3, maybe 4 more cuts, and then the market's going to say, hey, we are where we need to be, which is interesting because that implies a 4% floor on rates with a goal of 2% inflation, right? So you've got a 2% kind of, call it a real return, baked into that floor. I don't know if that's what will materialize, but with that in mind, we've also seen the yield curve move up across all maturities. And if you take the next, call it 6 months or a year out of the yield curve, you have a substantially more positively sloped yield curve. It's positively sloped between the 2 and the 10 today. It will at some point in the very near future be positively sloped, likely across all points. We have not had that in the last couple of years. And so that is telling us that, or I should say the interest rate market is telling us that the demand for longer duration treasuries has come down. Whether that's because there's a lack of faith of the credit worthiness of the U.S. government, or whether that's because there's a greater desire to own equities because there's a higher expectation of growth. I think both of those are reasonable, explanations for why treasuries would be yielding more and treasury prices would be coming down since the election. Either way, we are seeing positively sloped yield curve, which means that it's still fairly narrow, fairly flat-ish, but investors are being rewarded somewhat for taking on some of that interest rate risk, which is something that we have not seen in the last couple of years.
Well, we've been talking a lot about where the market is, what's going on with the yield curve, economic policy, fiscal policy. But the other side of this coin is the consumer. And I think the consumer's been relatively healthy if we see the CPI reports and other spending reports coming out. And I think part of that, at least part of what the market's pricing in, is a continuation of the TCJA, the Tax Cuts and Jobs Act. Which I wanted to pivot to real quick because I think it will have a big impact on businesses, especially as it connects to earnings that you mentioned before. 3 big things that the TCJA did was expand the tax bracket, so progressively you're saving more money as you go up through the tax brackets because they're wider. It also increased the standard deduction, and the vast majority of Americans don't itemize. They actually need the standard deduction, so there's a little bit more take-home. And lastly, it also extended the thresholds for certain taxes to hit you. Like, for example, this doesn't impact the regular American, but for the high net worth individual, the estate tax was set to be cut in half in 2026. Along with contractions of tax brackets and everything else. It was going to go from 13.6 down to 6.8, literally cut in half for the estate tax. And now it looks like, hopefully, there'll be some kind of negotiation to extend that because that's how the market is pricing it in as well. It's assuming that the consumer is going to have more money in their pocket to go out and buy things. And if that winds up being false and the consumer's got less money, then you're going to see a drop in earnings.
So is anybody talking about with the estate tax or with the estate, limitation specifically, so extension and an increase? Is anybody talking about an increase in the limit?
Typically, when we're talking about estate tax thresholds, annual exclusions, even 401k and retirement account contributions, there's typically an adjustment that's given annually that's centered around inflation, or at least inflation's part of the calculus. So, for example, right now, the estate tax threshold is $13.6 million. But starting in 2025, it's going to go up to 13.9. So that's what you can expect across the board if we continue the way it is.
Okay. So no substantial increases. No, it's not being talked about to double it or anything like that, right?
Yeah, I think the real concern was it being cut in half, not that there was an opportunity for it potentially to double an increase.
Okay. So that's an interesting dynamic, especially the tax side of things. When it comes to business taxes, income taxes, lower taxes definitely allow more money for consumption, which is good for the consumer. It's good for businesses that are consumer oriented.
And I think that complements the tariffs that we were talking about before, because if there's added cost on goods and you kind of have like I don't want to call it a consumption tax, but that's kind of what it is. If you go out and buy more things, it's going to cost you more with the tariffs. But if you have more money in your pocket, it can kind of help offset that.
Yeah, there's a little bit of a balancing, right? And you're also kind of seeing some of that with the slightly lower rate environment. So you have, we'll call it this, two things on the right side that are stimulative, right? Lower rate environment, potentially lower taxes. One thing that might be a little bit less stimulative would be taxes or higher prices. Will be interesting to watch play out will be if tariffs result in some higher inflation. Higher inflation typically is associated with higher rates. The Fed's mandate is one, to fund full employment, but two, to control inflation. If your tariffs start to result in higher inflation, and the Fed says, hey, well, we need to either dial the rate cut environment back or maybe even raise rates, I believe that will be a point of contention between President Trump or President-elect Trump and Jay Powell. And so we'll get to see that play out in real time if it actually does materialize.
The other thing that I thought about, Jake, from a tax perspective, is there could also be a potential lowering of corporate tax. So for C Corp,
I like to hear that. Yeah.
So for C Corps, and this kind of goes toward the balancing act that we're talking about here.
So just quick question: C Corps, are most public companies C Corps? Is that more private businesses? Most public companies. So if you own stocks, you probably own some C Corps.
Absolutely.
Okay.
Yes. Typically, private companies are S Corps and LLCs. And when it comes to that balancing act that we were talking about between the consumer and the cost of the business owner and what might be passed on with tariffs and things like that, the reduction of corporate taxes for those goods that might be coming imported could help offset some of the elevated costs that tariffs impose on the goods that are sold to the consumer. Yeah. So there's just a lot of pieces on the board, a lot of geopolitical bargaining, potentially some waivers that we covered. So there's a lot of cool moves from a chess perspective that you could potentially play out.
Okay. So we've got tariffs coming up. We've got the Federal Reserve, potential conflicts there. We've got some nuances on the estate planning side. It's been really interesting, Robert. Thanks for joining me again. I think the next time we get together, maybe we talk about regulation. We talk a little bit more, pick apart that tax situation that businesses might be facing going forward. Thank you all again for joining the Ask Avidian podcast. If you want to get connected or find out more, just come visit us at avidianwealth.com.